Hello, everyone. Welcome to the first educational session on rates. It's the first time we're doing it. There's a lot of content I have to discuss. I also have some quiz questions for you guys. But I also already feel like I was just saying, I have probably about 3 hours more content on this, but I'll leave it at 45 minutes for today. Let's get started, because it's a busy agenda. First, going to start with foundations. What does that mean? Yield curve decomposition, swap rates. And then I really want to focus a bit more on the macro side of things. So looking at monetary policy, what does that do for rates? Growth, inflation, risk sentiment, and also think about external factors, because we're not alone in this world. But for example, for euro rates, how do they get impacted also from other markets? The focus will be on euro rates, but also if you're looking at other rates, the concepts will be very, very similar. Foundations. Let's get started. So we're going to go through a learning curve. I think at the moment, some of you might be, well, the yield curve, what is that? Don't care, it doesn't matter. But I'm hoping to push forward, and throughout this session, we'll learn more and more why the yield curve does matter. But what is the yield curve? So the yield curve, very simple. It tells you what interest rate the market is pricing for different maturities. So here on the left, you can see the yield curve, the euro swap curve. You can see for each year, there is a specific interest rate linked to it. And it's as simple as that. So if you want to invest in a 10-year bond, you simply look 10-year, move upwards, and the yield on 10-year bond will be around this level. I mean, these are not the most up-to-date levels, right? But say here on this chart, you'll see about 2.7. And the same for the euro swap curve looks very similar. Now, of course, you might say, hey, what's the difference between a swap and a bond? And it is quite complicated. They're very different products. One is a bond, the other one is a derivative with a fixed lag, a variable lag. But for session today, I want to treat them as being quite similar in concept. So a 10-year fixed receiver swap is conceptually similar also to sort of funding a bond position. I won't go into the technical details, but I think the right-hand chart will give you quite a bit of sense. Look, these two rates really move in tandem. So if the 10-year bond yield goes up, the 10-year swap rate goes up. The spread between the two does change over time, and I could dedicate an entire different session to swap spreads, but that would be a bit more of an advanced topic. For now, we really want to focus, what are the drivers behind these curves? Why is the short end of the curve, which is the beginning of the curve at this level, versus longer rates a lot higher, for example? So for now, let's treat them as the same to understand the dynamics underlying them. So let's think about the yield curve decomposition. And to be honest, this is going to be the most difficult chart or the most difficult slide, but also really making the foundations for the rest of our analysis. So even if you don't immediately understand every detail on this, we will come back and practice this further on. So the yield can be roughly decomposed into an expected short rates component and a term risk premium. So what does that mean? So the intuition is, say you invest in a 10-year bond. You can choose either invest in a 10-year bond, or you can choose to just put your money on a bank account. Just get basically the variable rate, the overnight rate. You'll get a savings rate from your bank, which is very closely tied to the central bank policy rate. So you have two different ways of investing it. Either fix it for 10 years or opt for a variable rate, which will change over the period of 10 years. In theory, those two should yield a bit similar returns, because if one would return significantly more than the other, you would simply change your money into, for example, bonds. If bond yields would be a lot higher than what you would expect to earn on your savings account the next 10 years, then you also expect a lot of money to be flowing towards the bonds, which is not an equilibrium outcome. So expected short rates component is really a function of where do markets over the period of the maturity that you're looking for, so say the 10-year, where do markets see rates go from the central bank policy perspective? But this is not the entire part of the equation, because there's also a term risk premium. And the term risk premium is a lot more abstract of a concept. The term risk premium is, well, usually the yield curve is upward sloping. So usually you would say, well, doesn't it make more sense to put your money in 10-year bonds instead of on a shorter bond? The reason is that there's often a risk premium for holding longer maturities. Gets quite abstract, but very simple. You could think of it, hey, if you have to fix your money for 10 years right now by buying a bond, or you can keep it on a savings account at your bank and you can access it at any point, you would want to have a premium for locking in your money over 10 years. It's like a bit of a liquidity premium, you could argue. The term risk premium is a big topic of itself. Even just quantifying it is quite difficult because you cannot trade it directly. But in general, it tends to increase for longer maturities. And that's what I want to show you with the bottom right chart, where we decompose the yield curve. We have an expected policy rates component. So that's sort of the left-hand part of this slide. Where do we see the ECB go? Well, right now we see the ECB, for example, hike first over the first year, cut rates. Going further out. Please mute yourself, by the way, if you're still have your mic on. And then you have the term risk premium, which is very little for shorter maturities, but tends to increase for longer maturities. So that's an important concept to understand from here. But we're going to practice with this. This is the building blocks for reading the curve further. Just going back to the shape of this yield curve, right? So applying the knowledge that we just had, we know that the very front end of the curve is most closely linked to central bank policy rate. The central bank policy really anchors the front end of the curve, because for a very short amount of time, if you want to buy like a bond for 1 year, you could also put it on a savings account for 1 year. And like we said, the savings account will probably yield something very similar to the central bank policy rate. But thereafter, the curve does something different. Thereafter, the curve often tends to be upward sloping. So that's that term risk premium that is being built. And you can see the really upward sloping all the way to 20 years. Now, you might sometimes, if you look at yield curves going beyond 20 years or beyond 15 years, you might sometimes see it come down again. This is convexity effects. This is not something that I'll discuss, or sometimes it's also supply and demand, not something we'll discuss here in detail. But if you see this happening, it's not because markets have a clear thought on where they think, for example, the central bank will be in 30 years. No one is going to know where the central bank will be in 10 years, let alone 20 years, let alone 30 years. So it also means if we now understand that the central bank policy anchors the front end, it's markets that really drive anything beyond sort of 3 to 5 years, a lot more market driven. And that's what we see if we really line up these different parts of the curve in one chart. We can see the ECB policy rate. ECB policy rate, remember, they increase and reduce rates by about 25 basis point jump. So that's why you get that staircase pattern starting from 2022 going up and then down again. The 3-month swap rate, so that's all the way at the beginning of this curve, right, follows that very closely, because it's basically a bit of an average of the ECB policy rate expectations over the next 3 months, and we'll work more with this later. The 2-year does a bit more of its own thing again, but still close to the 3-month. It's just more forward-looking. So 2-year rates already look forward 2 years ahead, whereas the 3-month only looks 3 months ahead. And you can see when the central bank hiked rates a lot in 2023, already the 2-year rate was thinking ahead at some point the ECB will cut. But we're going to dive deeper into this. The 10-year does a lot more its own thing. The 10-year is, yes, broadly speaking, tied to the 2-year, to the 3-month, to the ECB policy rate, but especially in recent years, right? You can see the 10-year moving upwards, even though the ECB policy rate was quite stable around 2%. So to recap, front part of the curve, very much driven by central bank expectations. The further you go out of the front end, the more it gets driven by the term premium. So those were foundations. We're going to put these concepts into practice and see sort of how do these drive from day to day markets. And for that, we're going to zoom into the recent market dynamics that we had in 2022, because I think that was quite a good example how rates started very low but then slowly started rising because of inflation expectations. Because remember, what's the goal of the ECB? The number one mandate is keep inflation at target, the 2% inflation target. Very important. How it does that? It can increase policy rates, put a brake on the economy and financing costs, or worsen financial conditions, which actually allows inflation to come down again, and vice versa. As inflation is too low, it cuts interest rates. So how did this look? In 2021, interest rates were at zero or even negative for the ECB policy rate. And also the two-year rate was very close to the ECB policy rate. So basically, two-year rate said, you know what, nothing's going to happen. The ECB is just going to stay at this zero lower bound forever and ever. But then inflation started rising. Why did inflation rise? Because of oil prices. Oil price, Ukraine invasion. And at first, markets were a bit skeptical. Higher inflation, yes, but then it passed the 2% target. Maybe transitory was the important word used by central banks because it was supposed to just be a temporary thing. But already at the beginning of 2022, you saw that two-year rates started driving up. They started increasing. They did not believe that the ECB would be able to stick to 0% policy rate for the next 2 years. And that's, again, that forward-looking component of rates, right? You see the two-year rates go up already because inflation rises well before the ECB actually started increasing rates, because the ECB took, well, almost 6 months later before it started increasing rates. And then it kept going. And as long as the two-year swap rate was above the ECB rate, that's a signal that markets think the ECB will tighten policy even more, will hike rates even more. And that's exactly what we're seeing here. We see that the two-year kept on increasing, inflation kept on increasing, more and more concerns the ECB would have to tighten, until we passed the peak of the inflation. So we passed the peak around 2022, end of 2022, inflation started coming down. And only then did you see that two-year rates started stabilizing more horizontally, no longer increased. And we even had a point when inflation came down more, that the two-year was below the ECB policy rate again. So what does this flag? That means that the markets already look through the next 2 years and think the ECB has reached its peak in terms of tightening, and the next step will be easing. And they were correct, right? They soon thereafter, the ECB could hold the policy rate, wait for inflation to come down. That's that horizontal line that you have here. And indeed, you can see the two-year swap rate was already well below the policy rate, anticipating further cuts. And that's when the cuts came. The cuts came in and we move forward. Markets expected the ECB to halt at 2%. And this is that beautiful equilibrium that we had at the beginning of this year. But that good place, as Christine Lagarde iterated many times, was broken. And now you can see recently two-year swap rates have been going up again. Why? Because inflation expectations have increased, and that translates to expectations that the ECB will be hiking rates again, which they already did in July. So this forms a very important part of the rates analysis. You really need to think ahead. Where do we see inflation go in the future? Where do we see the ECB policy rate react? Because keep in mind, markets are very forward-looking. Now let's zoom in. What are the market dynamics around these rate decisions? Because often what I hear in the media is like, oh, the ECB hiked rates, so therefore we expect 10-year rates to go up as well. It doesn't work like this. It's all about what's already being priced in. What are the expectations for markets when it comes to ECB policy rate hikes versus what the ECB actually does? So we zoom into that portion 2022, 2023 with the ECB policy rate and two-year swap rates, so really zooming into part of the chart that we had before. And you can see in December 2022, they hiked 25 basis points, the ECB. And indeed, as you would usually intuitively expect, the two-year swap rate went up as well. Because you could say, well, that also increases expectations of future rate hikes. But it doesn't have to be the case, because we also in March 2023 also had a 25 basis point rate hike, but actually we saw a sharp decline in two-year swap rates. So why is that? And that has all to do with the positioning of markets going into these meetings. And we use Bloomberg for this. This is the WIRP function, WIRP, probably the most used Bloomberg function by myself. And you can see how do markets price in future rate hike decisions. So here we zoom in to the April 2023 meeting, which was this where the red arrow downwards. You can see markets were actually pricing in 28.7 basis points of tightening. That's more than the 25 basis points. So what does that tell us? That tells us markets were convinced it would be 25 basis points, but also had the idea it could be a 50 basis point hike. Because sometimes the central bank does that. When inflation is rampant, which probably was at the time, a 50 basis point hike can be done as well. So this was actually disappointment. So actually they hiked by 25 basis points, but because 28.7 basis points was priced in, markets were actually disappointed. And they actually thought, oh, maybe the ECB is going to be more dovish in the future. And that's how you can see a sudden, very sharp decline, almost 100 basis points around that meeting, because the ECB did not actually fully deliver on the expectation. So that's very important to keep in mind. Even though the ECB could hike rates, it doesn't mean the rest of the curve has to increase as well. It could even come down depending on what's priced in. Now let's look at it further out the curve, right? So we've really focused now on the front end. So the 2-year, you can usually have a reasonable prediction because 2-year rates, we know what macro does. We know that inflation takes about a year to really pass through. So the 2-year rate is heavily determined by what the ECB does. But let's look at the 10-year swap as well. So 10-year swap rate, you can see here is the blue line, whereas the orange one is the 2-year swap rate. On average, the 10-year is above the 2-year. That's that positive term premium that we were talking about. But sometimes that can invert. And that inversion is often highlighted a lot also by the media as a recession indicator, because what does that tell us in the inversion? We had a big inversion here in 2021, 2022, because the 2-year swap rate increased beyond the 10-year rate. So this is markets saying we expect the ECB in the near term to really tighten policy, really hike well beyond long term where we see the ECB go. And that means the 10-year doesn't have to follow all the way up. So here you can see that as well. You can see the inversion happened around 2022 simply because inflation was really high at the time. It wasn't about recession risk, a lot about inflation. So where does that 10-year then have to go, right? The 10-year, if we say that's a more sticky one, doesn't follow up and down depending on ECB. Well, it's a very tricky one. Where does the 10-year? It's fair value, very difficult sometimes to pinpoint. But one way of thinking about it, it should be anchored around the market's expectation of where the terminal central bank rates are, plus a term risk premium. But first, let's focus on the terminal ECB rate. Often the way to communicate about this is through the concept of a natural rate of interest. And this is a function where do markets over the long term, or where do sometimes academics, the central bank, over the long term think that the ECB should hold their policy to that's consistent with exactly 2% inflation. So right now, markets think that's around 2% for the ECB. So the idea is once we get through this inflation shock, probably the ECB will return to around 2.25%. And that's a very stable equilibrium, because that's also where we were at the beginning of this year, right? We had inflation at 2% and the policy rate was at 2%. Estimating this is difficult, and often it's a function of where we think long-term growth estimates are. So I like to think about where the 10-year as a long-term growth, a nominal long-term growth estimate, and that also explains why over time we've seen the 10-year come down. In the year 2000, the 10-year was quite normal, around 4 to 5%. But now we're looking at 2.8, 3%. So a big part of that is simply Europe is not growing as fast as it used to. So that also reduces this equilibrium rate where we see the ECB going. But that also raises questions. For example, does productivity gains from AI, does that really shift this natural rate of interest? Does that mean actually interest rates are going to be higher in the long term? Or there's also other counter arguments from Warsh that he thinks productivity gains should actually be deflationary and bring down the natural rate of interest. So Difficult concept. There's no conclusion exactly around which it's anchored, but I always like to think long-term nominal growth expectations usually do quite well for a proxy. Before I'm going to give you the word, because we've got a question after this to read yield curves, I'm going to give the yield curve that we had last week and just putting everything together. What have we learned so far? We're looking at this yield curve. We see it's anchored at the beginning. That's because of the ECB policy rate. We see a little bump here. So we see it go up and then down, and then we see it grind higher again. What does this tell us? Well, the little bump is exactly what we're seeing with inflation. Markets are expecting inflation is going to be high. The ECB is going to raise policy rates, causes the bump, but it's going to be a temporary inflation shock. Afterwards, they're going to cut again. And that just means a temporary transitory inflation shock, a word we shouldn't be using, but this is exactly what markets are saying. Thereafterwards, you see the term risk premium building. So you see beyond 5 years, this gradual upward slope. Usually a positive term risk premium also means relatively healthy risk sentiment. So there's no pessimistic view on recession risk. And it just means afterwards we have a bit of a normalization of policy. The ECB is going to pause at its natural rate of interest and happy days. And we can even test that bump on what we see on the word function. I'm not going to go into details, but you can indeed see markets are expecting still 1 to 1.5 rate hike over the next 12 months. Now I'm going to leave it to you. I've got a question. I took a yield curve from somewhere between now and the year 2000. And I've got 3 options on how to interpret this. And it's the most likely explanation. And we've got 3 options. We've got A, the market sees the ECB cut from 5.5 to 4.9 over the next 10 years. Is that the most likely explanation? Is it B, the market sees the ECB hike in the near term, but a steep cutting cycle thereafter? Or is it C, the market sees stable macro conditions with no change in monetary policy? The answer, correct answer, what is the, can we see the results? You can see the results. Okay, Luke, tell us, what are the results?
87% option B.
87% option B. Okay, perfect. Well done. Because I picked a moment just before the financial crisis of 2008, 9th of June 2008. And indeed, what was happening? Inflation was on the high side. Markets expected the ECB to still hike in the near term, but were quite pessimistic on the outlook thereafter. And also, that's why you see that little bump at the beginning, ECB hiking, but thereafter this downward sloping curve. And actually, markets should have been a lot more pessimistic because it didn't really stop after this. And we all know what happened in 2008. Perfect. Good first result. We are now at the second phase before we move to the third one. We now think the yield curve perfectly predicts recessions, but we'll learn it's a lot more complex. Let's look at growth as the next one. So what does it mean when the economy grows strongly? What does that mean for rates? Well, very simple. You could say higher growth, that adds to inflationary pressures. That means the ECB needs to hike. And also higher growth usually tends to correlate positively with the term risk premium. So posing upward pressure on rates at the long end as well. This is a very simple chart, but I think it's quite a nice one. It looks at Eurozone composite PMIs. And composite PMIs are always one of my favorite indicators together with economic surprises. It's simply a survey to businesses. How optimistic are you about the future? If it's above 50, great. If it's below 50, that means there's more of a contractionary growth outlook. And you can see over the past year, before we had the March with Trump, disrupting everything again, there was a bit of that cycle was clearly visible in rates. We saw a bit of disappointment end of 2024. There were some recession fears, but growth picked up again. Even though we had Liberation Day, growth numbers just dipped a bit lower just after Liberation Day, but they strongly recovered thereafter. And Europe was in a pretty good position before Iran. Now, you might ask, wait a minute, you're telling me growth should correlate with rates, but we see that correlation break. And that's because this is the growth side. But markets have different areas where they focus on at different points in time. And growth is not the focus at the moment. It's all about inflation. And also keep in mind, the number one target of the ECB is inflation and not growth, even though the Fed has, for example, a bit more of a dual mandate where growth is also important. So that's growth. I'm going to keep it short on that one. Inflation. A bit more complex, I would say. Roughly, you can separate nominal rates. So nominal rates is what we're looking at, right? It's just the normal yield curves. You can separate those in inflation expectations and real rates. Inflation expectations are best read, in my opinion, from inflation swaps. So these are actually traded products. You can trade them, and they pay you depending on how high inflation is. Real rates is basically residual. So I look at the 10-year swap rate, I subtract 10-year inflation swaps from it, and the resulting part is the real rate. Now, they can move in different directions. You can have the one go up and the other go down. Very roughly speaking, you could say inflation swaps are mostly driven by inflation. Real rates are a bit more on the growth side, a bit more growth driven. And that's especially more recently where we see that growth expectations, for example, in the US have really picked up. That really pushed up real rates in the US and also has spillovers to the Eurozone. First, I'm going to focus on that inflation component because it's really important. If inflation goes up, rates go up. So how do we look at inflation? And it's quite easy to identify what are the biggest drivers of inflation. On the left-hand side, I just draw 2-year swap rate versus oil. Important, yes, the two are correlated, but it really depends, again, on the regime. Like sometimes oil is all that drives two-year swap rates, which is what we sort of come out of the last few months. But there can also be periods where they don't move in tandem whatsoever, and the correlation is quite low. So it really depends whether markets are focused on inflation at a particular time and how important oil is in that story. The other one is growth. So growth you already mentioned earlier. If growth is good, that's inflationary. And oil and gas, like I mentioned. So what you can do is you can very simply already model inflation swaps as a sort of a proxy for inflation expectations by the market by regressing that on inflation, so past inflation, growth surprises, oil and gas. And you can see even throughout this very volatile crisis we've come from, such a model is still able to capture the dynamics quite well. That's really near-term inflation. But longer-term inflation is usually not driven by things like oil as much. So here we look at the 10-year inflation swap in particular. So this is really looking far ahead. And it's important to understand we have had different regimes in this. Before the global financial crisis, markets were quite confident that we would be looking at a 2% inflation target. So inflation over the long term, over the next 10 years would be around 2% plus an inflation risk premium. It's a bit like the term risk premium, but then for inflation and equivalent. Then we had secular stagnation. Then markets really lost confidence in the ability of the central bank to keep inflation at target. And the central bank was in a problematic position because their policy rate was already zero, so they couldn't cut rates further. So they had to resort to things like quantitative easing to bring inflation back to target. But markets were very picky, and they expected over the next 10 years, I do not expect inflation to get back to target. But now we're back, actually. We're in a pretty good position, I would argue, because the inflation 10-year swap is close to 2%. That means, first of all, markets are very content with the ability of the ECB to keep inflation at target. And they're also not too worried about secular stagnation, because if secular stagnation risks would be there, you would expect the number to be well below 2%. I would argue this number could even go higher because we still don't really have that term premium in inflation risk that we saw before 2014. So that could still pose some upward pressure on rates going further out the future. Now, back to questions. Question number 2. What is the most likely explanation behind the shape of this yield curve? So what do we see? We see the front end anchored quite low, around 1.5, back end 3.5, 4. 3 possible answers. And again, it's the most likely one, right? Like there's always possibility to argue in favor of everything. A, the market thinks the policy rate is below the neutral rate and should rise gradually. B, the market sees little inflation now, but expects high inflation in the far future. Or C, the market sees stable macro conditions with no change in monetary policy. And Luke, what do we have as the answers?
Bit of a mix, 39% A, 41% B, 20% C.
Oh, interesting. Okay, so we have a bit of mix between A and B. Indeed, like I said, you could argue in favor of B as well, but in this case, A would be the more sensible one. And that's what you see in long-term inflation expectations. It's very unlikely. Remember when I said how we model inflation? One of the key components is also current inflation, or so the last inflation readings. It's very unlikely for markets to already think that inflation will be low now, but in 5 to 10 years will be high. Markets usually don't really have a good view on that very long term. And what we see in the curve here on the left is a very steep yield curve. Front end very low, 1%, long end very high. And this was actually a curve I took straight after the global financial crisis hit in 2010. And this was where markets were really thinking, okay, maybe the ECB cutting rates to zero is just a temporary thing. And afterwards, things will get better. And, within 2 years, because you can see how high the 2-year swap rate is as well, right? In this chart, already within next 2 years, we'll have the ECB hike at least 100 basis points. Markets were wrong on this one, because you can see actually the ECB had to cut even further and actually lasted there for almost, more than 10 years. So that doesn't mean yield curves are always correct. But in this case, I would go for answer A. Let's look at risk sentiment. Last 2 chapters before last question. Risk sentiment is a bit of a vague concept. It's how enthusiastic are risk markets about risk assets. But what you have these different episodes of risk on, risk off. Risk off is usually where markets are getting a bit panicky and everyone looking for safe havens. Usually something like gold can do well. And then usually also bonds can do very well. So the idea is when you get very uncertain about the future, you get 2 options. Either you invest, for example, in equities, which have to pay dividends, which you have no idea how much it would be in the future, or you invest in bonds, which have a certain payoff because it's a fixed coupon, it's a fixed yield. So usually what you see, if the VIX increased by more than 5 points, so here are all the months where that happened, the VIX increasing is a bad risk-off indicator. You can see usually bond yields really decline, rates really decline. And that's that negative correlation that you have between equities and bonds. Because remember, lower bond yields is higher bond prices. But it does depend where the risk-off scare comes from. Because if it comes from inflation, you have a very different dynamic. If suddenly inflation rises, which is actually what we've seen most over the past 5 years or so, bonds do tend to do very badly during risk-off episodes. So that's why it's a quite difficult correlation. When it's growth related, that's a rule of thumb. If it's growth, if the worries are about growth being worse in the future, it's good to invest in bonds and it actually pushes yields down. When it's a scare about inflation being higher in the future, you don't want to be in bonds because yields tend to go up. And here I also do a bit of the case study, right? What happened around 2008? You can see VIX really rose. That's an indication that equity markets are very nervous and expect more volatility. Corporate spreads really widened, also very bad. And as you expect, their 10-year and 2-year swaps rates really came down significantly. So this is the growth scare really showing up in the rates market. Then we have the last chapter, external factors. So now I've really focused on how you read it from a very isolated perspective. So really focusing on the Eurozone in particular. Of course, you could analyze this from any perspective, but you have to understand there is an extremely high correlation between yield curves. So here on the left, I have the 10-year government bond yields. You can see especially the US gilts, bunds, very correlated, especially in short amount of times. The JGB, that's the Japan government bond market, slightly different, but they really resorted to unconventional monetary policy, yield curve control. So you really need to be very aggressive as a central bank if you want to go against global trends. But the correlation does change over time. So correlations can be high at some points, can be low at other points. Here I take a chart around the US elections, where you can see before the US elections, Trump got elected. There was a very strong positive correlation between Euro and 2-year US rates. But US elections, that really weakened. You could argue the correlation also weakened because of slightly diverging monetary policy, but definitely markets started seeing different paths forward for the Fed and for the ECB. So that's why you can't blindly follow always on tight correlations, and you need to also recognize when there's a regime change and markets look at different things at different times. So why do these correlate tightly? And that is, first of all, I mean, we have a global macroeconomic cycles, right? Like oil prices going up means central banks all over the world will hike rates, which means rates all over the world go up. But there's also a global term premium, global risk premium going on. And here I look at the steepness between the 5 and the 10-year curve. So really that part of the curve that really captures that risk premium for holding higher maturities. And you can see if you look at all the different large markets, so here I include G10 markets and the min and max of those, you can see there's cycles in this. So that really tells us that over time, you do have a risk premium that varies and also at a global scale. And you can see if you take the average of all the 5s, 10s curves of these major markets, you actually have a very good proxy for what the Bund curve is doing. So it really tells us you cannot look at these yield curves in isolation. You need to understand what's happening in the broader markets and especially what's happening in the US, because the US is the dominant factor. And this is, I think, my very last slide before we have a last question. Putting this all together, so we have realized ECB expectations are very important. So where do we think central banks are going, which are best captured by the short end of the curve, right? So let's say we know what the ECB will be doing over the next 2 years. So we have quite a strong view on the 2-year Euro swap rate. Today, we also have a strong view on the 10-year US rates. So Porrick often, our US rate strategist, gives those numbers. And we have a view on the term risk premium of the US curve, so the 2s, 10s of the US curve. You can see those are all very correlated. 10-year US Treasury yields and 10-year bond yields, very correlated. Also the term premium, as in the difference between the 10-year and the 2-year rates, also very correlated over time. Put that all together in one model. So we simply have a model where we want to know where would the 10-year Euro swap rate be based on where the US 10-year would be, where the US 2s 10s is, so the spread between the 10 and the 2, and we take a view on where the 2-year ECB expectations are. Those variables together have an R-squared of, say, 97%. So very roughly speaking, 97% of your rate moves can be determined by this. So that's why it's super important to not look at this in isolation, but also know what's happening in the US if you want to formulate a rates view, whether it's Eurozone, but also other markets. Okay, last question. What is the most likely explanation behind the shape of this yield curve? So A, the market thinks the policy rate is below neutral rate and should rise gradually. The market sees rate cuts as the long-term growth potential looks weak. Or C, the market sees stable macro conditions with no change in monetary policy. Okay, Luke, what do we have as our answers?
50% on C.
50%?
41 on A.
Ooh, okay. So indeed, we have a competing one between A and C, and I do see why also A could be a valid one. But what I did was I took the curve from just before the turmoil happened with Iran. So this was a point where the ECB was in a good place. This was the point where listening to Lagarde for 45 minutes during press conference was the most boring thing ever. And this was where we were hoping to stay for a longer period of time. So, but actually, I would argue this was one period of very stable macro conditions, no change in monetary policy. So the reason why from this yield curve I would not have gone for A is that you can see the term premium is not that steep. So compared to the previous question, we really went from 1% to 3.5% in the yield curve. Here we have just about 70 basis points of yield curve, which over a longer period of time, having a difference of 70 basis points between the 2-year and the 10-year is very normal. If anything, I expect that to still rise a bit more. But what you could see is that the actually expectations of the ECB hiking at the time was close to zero. So if anything, there was a slight cutting bias as well in the near term. So the correct answer would be C. Yeah, but I do also understand why some would think A, but it really has to do with how steep the yield curve is. Good, nice. So that was the last part. We made it. That's a lot of talking, a lot of information, a lot of content from my side. We went from the yield curve doesn't matter to the yield curve perfectly predicts recessions, which is what the media always loves, to, well, it depends, global term premium, inflation expectations, market sentiment, blah, 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 and a lot of other factors. So it's a lot more complicated than just it being a recession indicator. Thanks a lot for everyone. We are here to help you guys. Also feel free to always reach out for either clients have questions or you just want to learn more about rates. We also have our Think website, which is very popular, and where you can also sign up for our newsletters, not just rates, but also other market topics. Thank you very much, everyone. And if you have any questions, just put them in the chat for later.